Shares in gold mining companies are often seen as a leveraged position on the gold spot price because what happens in up markets is that they outperform the gold price, but they underperform in down markets. So it amplifies on the way up and it amplifies on the way down. 2024 was an outstanding year for the gold price. Gold prices against US dollar went up around 30%, yet when you look at the large publicly listed gold mining companies, the returns on the year was actually negative. And some of the famous names in the industry, such as Barrick Gold, they were down 20%, Newmont Mining down 9%, all during a year when gold prices were up 31%. This has obviously raised a lot of questions with investors. So, Auronum has done some extensive research and we've published an article on our website which explains in full reasons why gold mining companies do not always benefit from a rise in gold price. You can go to this description on YouTube and click the link, which will take you to the full research. But I'm going to breeze over some topics because the reason why miners underperformed in 2024, it's like the answer has several layers to it. So we're going to peel back some of those layers and unveil the reason why gold miners performed so poorly in 2024. We published a very interesting article which discussed gold and its backward rise in supply curve. This means that when the price of gold goes up, generally speaking, the gold supply, the amount that miners produce, actually falls rather than goes up, which is a bit of a paradox. But when you think about it from an economical standpoint, it does make sense. Gold miners will shift production on their claims to areas where the gold is less dense because it's become more economical to produce that gold because the gold is worth more. So when we get periods where the gold price has gone up quite quickly, you would expect gold miners to benefit from that. But what might be happening is that that gold miner will then shift production and mean that even though the revenue is consistent, they're actually selling less ounces to the market. Another reason why gold mining companies might not necessarily benefit from a rise in gold price is forward hedging. If you are the owner of a gold company and you know you're going to produce 1 million ounces of gold next year, what you can do is you can decide to hedge some of that exposure. So you would enter into a forward agreement with a buyer where you would say, I will supply you X amount of ounces at the current market price, which will be the forward contract for that delivery period. If you've already locked the price for a lot of your production and the gold price goes up, you have to sell that gold in the delivery period at the price that you fixed in the forward contract. If there are gold mining companies that have sold a substantial amount of their output forward and they've hedged and the gold price goes up, their revenue is not really going to benefit. So that's a couple of theoretical reasons as to why the gold mining companies might not necessarily benefit from a rise in gold price. But when you look at 2024 in itself, there was something quite unusual about that gold rally. Some leading analysts spoke about the gold price rally in 2024 as climbing a wall of worry. It was almost as if a lot of the market just didn't believe the gold price was going to continue going up and everyone was expecting a correction. When you talk about gold mining companies and the spot price, they are driven by slightly different things. The gold spot market is a function of supply and demand in the very near term. But gold miners are much more forward looking than that because I'm only going to buy shares in a gold mining company if I think the price of gold is going to stay high or go higher over the next year to 2 years, maybe longer. So it's much more thinking about forward movements rather than what's going on with the spot price right now. And I think that's one of the biggest reasons why gold mining companies just didn't perform in 2024 because the spot price was going up, but the general consensus was very negative and expecting a big pullback in the market. The other factor in discussing sentiment that worked against the gold miners was that the hot capital that was chasing the exciting gains was looking elsewhere. Bitcoin, US tech stocks, these were all rewarding investors that were speculating in short-term movements. The gold mining sector just didn't benefit from that. So a lot of the capital that could have given the mining companies short-term gains, it just wasn't there. The mantras and the rhetorics coming out of the financial media was that the US economy was doing great, that jobs were increasing. So, why again would anyone want to invest in what is a safe haven asset? Between 2009 and 2018, global gold production was increasing year on year. Since then, it has stagnated, which could suggest that miners have shifted over to lower grade ore, or that some miners are having to work harder to get the gold. Potentially, they've got a lot of the low hanging fruit gold in their claim already, and they're needing to go deeper and open up more areas, which is causing a stagnation in global gold production. When it comes to gold mining, there's a very important key metric that we use to determine the profitability of a miner, and it's called the all in sustaining costs. And what this tells investors is how much it costs that mining company to pull an ounce of gold out of the ground. So it's a really important metric in understanding the profitability of a mine. The all in sustaining costs varies across the world, with Australia seeing some of the lowest cost producers. But the World Gold Council, each quarter, they will publish an overall aggregate look at the all in sustaining costs of gold miners globally. The all in sustaining costs of mining an ounce of gold in 2024 was around $1,400 per ounce. Whilst this figure provides miners with a comfortable margin, the all in sustaining cost has been rising since summer 2020. Some of this could be explained by rising input costs such as energy, parts, and also labour. Yet it could be because a lot of the miners have already taken the low hanging fruit gold from their claim and they're needing to work harder to extract the gold. Looking at some of the largest publicly listed gold miners, you can see that the share prices since around 2019 have actually done quite well relative to the price of gold. So potentially there was some profit taking going on leading into 2024, which put them at a wrong footing against the gold spot price. So even though in 2024, you could say gold miners were underperforming gold by quite a significant margin, when you look back over the last few years, they have done quite well compared to the price of gold. And this is probably another significant factor coupled with sentiment as to why we saw such a poor performance in 2024.